Thank you, sir. This is Rakesh here.
If you look at these three parameters, and somehow to some extent they are interrelated, if you can take care of these three things, I think a quick perspective you can get in terms of how healthy the company is and how
intensive business, and which is happening today. You have to do one side, you have to do a servicing of that capital cost, because the cost of capital is very high to run the business in India. And on the other hand, your working capital cycle, which is triple C, which is expanding, ultimately eating out your bottom line completely. So what is most important in this case, we have to create pull in our product. We have to create product differentiation in our product, so that whatever the cycle we are talking about, it is nothing but, we are talking about we have to delay the payment, we have to take we have to sell, or we have to, delay the payments, and we have to take the money early. So what we are talking about when you're talking about this whole complete cycle, and if we are going to reduce that particular cycle, and you can do a lot of
wage businesses which typically cater to B2C, which are typically B2C kind of models, it's not so relevant working capital cycles are, because receivables are pretty much instantaneous, right? So there's no receivables per se in the business, hardly any inventories if you are an e-com digital mobile kind of an aggregator business. So really a working capital cycle sometimes becomes irrelevant to new age businesses to some extent. Which is not to say that you don't need to manage your cash appropriately, however, but for the context of a lot of people or business or entrepreneurs in this room, probably it will not be as relevant as what it would be to the traditional manufacturing sort of businesses, which would have huge inventories and huge receivables for 2 months, 2.5 months, and that's when really they need to manage their cash cycles so much more prudently as compared to probably a lot of in the room.
So basically, this thing two school.
Understand how the companies are doing, but like most things, you really have to dig into that. Right? When you're investing in a company, what are you doing? You are actually becoming a part owner of that company, right? And as a part owner, you really have to think and say, what are the key things that will help this company succeed? Because if you don't do that, then it really does not matter. You're thinking about the future, right? And the three things that I think about, one is the management. Is the management going to be aligned to you? Unfortunately, earnings per share does not really reflect anything about that, right? And management to some extent is really qualitative, right? So if you think about how good a manager that is, rather than worry about earnings per share, worry about are they increasing the market share, and therefore that way they're becoming a much more potent force in terms of succeeding. And I would actually worry about those three things rather than look at the earnings per share. But I would say that earnings per share is the first good metric to look at, and if it is too expensive, then you might want to reconsider whether you want to invest in that. And then lastly, there is a concept called owner's earnings. So this goes back to what Mr.Rajeev was saying earlier, which is really you have to count the cash at the end of it, right? Earnings per share does not tell you.
Easy, right? Because many companies, when they take a debt, what I realize that EPS is good metrics for companies who deliver good returns on their capital. But it's not a good sign for companies who are not returning the same kind of growth. So taking this point, I'll open this panel for our audience, and
it looks really nice. Oh, this has been a multi-bagger, this went up 15 times, 20 times. But if you want to sell 20,000 shares of that company, it hits a lower circuit for the next 20 sessions. So there is a huge question mark that whether we can look at any of these numbers. A last one, when we talked about cash flows, I think it's very critical to look at the free cash flow, more important than the cash flow. And one part, which is to see that which part of a balance sheet is there that if an auditor, including the Big Four, certifies that they will go to jail if they wrongly certify. And the only element there is the taxes and the payment of statutory dues. Everything else is as given by the management. So can you believe a balance sheet when you see it, especially in the light of all the things that we've seen over the last 15 years and slowly coming out?
So quickly, what are your questions? Quickly, that is more important. You have given the solution. You have to know what is your question. Although this is your this is your wisdom and this is your advice, which we are okay with that. What is your question?
The question is, when you look at KPIs on the financial side, what is it finally that you come down to?
You ask me HPS because I can answer that, because I am one of the founding team member of the private banking of the bank when the bank started off.
I'm saying that when we talk about valuation and a KPI and something that justifies it, every research report that I have read, all the 45 top brokerages have put HDFC Bank on a buy list, and nobody puts Deutsche Bank on a buy list, which is 15 times the asset base of HDFC Bank on the same global market cap.
Let me share with you when you talk about the key parameters. When you look at the banking balance sheet per se, there are 4 or 5 things which you have to see, and the most important thing in the banking balance sheet, you have to see the NIM, which is called net interest margin. And this is the only bank since inception consistently maintaining a NIM margin of almost 4%. That is number one. Second thing, which is the most important thing, if you have to look at that kind of a franchisee and the kind of comparison which you are doing with the global bank, there is no relevance for it, because the point is, as I think sir's slide, it is the land of an opportunity. It is a land where there are challenges. It is a land where there is a people which is unbanked. This is the place. I just want to share with you, when I started my career with the treasury of the bank in Bombay, they told me, you want to join, you want to go back to your territory in Punjab or Haryana. I told them, yes, I want to work there. We only have at that time 7 branches. Today only in Punjab, HDFC Bank has 410 branches. This I am talking about only 5 years. So what I am saying is that when you talk about the growth, the potential, the opportunity is so big. Secondly, the best thing which HDFC has done per se is basically prudent management, which has not looked at the top line. They always looked at the bottom line, because I worked with the top management and one of the founder of the bank, who is still the founder and in the top management. So they always looked at the bottom line of the opportunity. That is number 2. Number 3 thing which they have done differently is the technology. They have Mr. Ram, who was there, startup when the bank started, in a cabin of 10 by 10 room in 1994. When they started that, and today, which you have already shared, the market capitalization of HDFC Bank, which has gone beyond SBI, which is having a legacy of 150 years or something like that. So the third thing which they have done very good in terms of, which is very important in terms of the retail franchisee, they have not given the loan to power, they have not given the loan to infrastructure. So what happened with that? Even today, I am not looking at the net NPAs, I am looking at the gross NPAs less than 1%. So the point I am sharing with you is,
Iqbal, now you are talking the real KPIs.
So last but not the least, which is the most important thing today, this is the only bank, again I am just looking at relative to HDFC Kotak Mahindra Bank also. Since inception, I don't think so any bank like HDFC has delivered more than 30% CAGR, and that kind of growth will continue in future also. The kind of opportunity which is there in terms of the people unbanked, the retail segment, and if our economy is going to start reviving, the retail franchisee, which is going to be bread and butter for the organization or the corporate or for the bank, will continue to deliver, at least for, this is my projection, it will continue to deliver 25% CAGR going forward for at least one decade. And if you look at the CAGR of Kotak Mahindra Bank since inception is around 47%. I think the point that I have to share with you, and I got an opportunity to travel with the managing director of SBI last month in Paris, so where we have attended the Global Investor Conference. So he shared a lot of things personally with me in terms of how their hands are tied up in terms of managing the show and managing the ship. And he shared with me that we have almost 5,000 people in SBI who is just doing a replying to the RTA application which was dropped in our system. So again, I'm saying coming back to the central point, I think it will continue to grow because the kind of opportunity is very huge and the kind of enabling technology. Again, I'm saying technology is not the solution. Technology is the platform, and which they have done it or which they have used it very efficiently, very effectively, and when the tide is going to get turned, they are going to maybe deliver more than 25% CAGR going forward. Thank you.
Thank you so much, Iqbal. I think we are running late. I think the two hands I can see. Quickly, can find in the next 2 minutes. Please go ahead.
Yeah, I'm Deepthi. I have two small questions. One, of late we see a very strong trend where businesses are looking to convert their capex into opex. So I wanted to get your perspective as to how healthy is that for business. And secondly, the point that you raised about owners' earnings. What can be some reasonable expectations around owners' earnings?
So I will start with the second question first. Okay. So when you say reasonable earnings or expectations around owner earnings, it really depends on the industry or the business. You cannot have a broad brush expectation around owner earnings. Now, the real thing that we have to look for is that is the owner earnings in terms of the return on investment meeting your threshold, right? And you can define what your cost of capital is or what are the returns you're looking at. Some people are happy with 10%, some are looking at 20%, and you always, only point is when you're looking at the returns, account for the fact that many times companies are investing in their growth, and that you should take away, because when including the growth as part of the cost of the growth as part of the earnings, then your earnings will be lower. So you have to strip away that cost and only account for the maintenance capex, right? And there, if you are earning more than your cost of capital, and my general sense is I use 15%, so if I'm earning more than 15%, that's something that I'm happy to invest, especially in a market like India, where if you think about other forms of returns, like a fixed deposit, which gives you like 9%, post-tax is 6.5%. And then you come to equities where it is 15%. But that is an individual choice. So what is your cost or threshold, right? Now in terms of the OPEX versus CAPEX question that you asked, clearly if a company is making a CAPEX into an OPEX, it will hurt the earnings for that particular year, right? Because it is going to benefit. And in fact, if you think of a lot of consumer good companies, that's what they do. They are advertising, and that advertising is going to help them over the next 10 years or so. But that is all going into the OPEX, right? And therefore reducing the earnings. But really, if you think about it, it will benefit the company. And that's what typically a CAPEX is, right? So if I'm building a plant, it helps me for 10 years, that's a CAPEX. Similarly for the advertisement, if a company is doing that, they are much more comfortable, or they are very conservative companies, how I will look at it. And therefore that's something that I would be much more keen to invest in. Just because they are taking the pain today for the gain tomorrow.
I just want to add one more. One of my client last month, he got a deal. He sold his business, which he started just 5 years back, around 1600 crore. It's a small brand, you must be aware of, Case King, which was bought by Nomi. I always advise to the people who are a startup, especially, they have, or even for the businesses like Hindustan Lever and all other players, what they are doing today, they are not doing any investment on CAPEX. In fact, they are completely selling their non-core businesses also. So what is my advice to startup or the businesses, that they have to keep their asset light. Whatever is your USP, whatever is your strength, whatever is your passion, stick to it, and all other things you should not consider it. I'll just give you a very small example. Fortis is the multi-speciality hospital. One of our client, which is IB Hospital in Punjab, he started the same model, multi-speciality hospital. He's saying my specialty is only managing the doctors and the latest equipments and technology. When I am investing 100 rupees, out of that 50 rupees will go for a land, 75 rupees goes for a building, and 25 rupees is where, where I come from, which is my USP, my strength. So what he did, he opened up 7 multi-speciality hospital in that particular region, keeping the asset light, whereby it has been completely leased the properties and put up their own strength or the USP, where it has multiplied his room 4 times, and at the same time the per room for a multi-speciality cost has come down so less, and he's focusing more on leveraging whatever is your USP. So what I advise, generally for a startup for 2, 3 or 5 years, we just carried away to venturing into those areas, which can always be, outsourced, and keeping the asset light will always make, things healthy. And if you see in last 1 or 2 or 3 years, the return on equity in most of the companies where the assets are light, has delivered a wonderful return from the client's perspective, which is ROE.
Thank you. I think there's one question. Can we take it offline because we're really running late, almost 1 hour.
Last question, please.
Just very small question. If can I?
Please go ahead.
Yeah. What are the other parameters other than you said top line and bottom line to get a better valuation for an startup company? And second thing, how long you can call a company as a startup company? Because some people call Flipkart is still a startup company.
So the 2 questions you have is, apart from the 3 parameters that we broadly discussed, what are the other parameters that we could look into to help increase the valuation of a company? A and B, what exactly is a startup company, or what is the definition of a startup company? So, well, the first question, what are the other parameters to help improve the valuation of a company? See, it's a function of maths and comparables, really, valuation. It's a mix of art and science, Obviously, there is science. You do a mathematical model called DCF, where you take care of the cash flows, pull it back, readjust your variables, and then you get a number to what the company is. But obviously, deals are not really happening just based on the maths. For example, some of the astronomical valuations that Ola or for that matter, Book My Show, or more recently Paytm for that matter, the kind of lease housing for that matter, the kind of valuations that these guys got, it was clearly not in sync with the kind of revenue projections that they had. It's also a function of the disruption that you anticipate you can create in the market, and that really is the $1 million trick to get a good valuation. You have to be able to convince the person on the other side of the table that you will take a market and you will turn it heads, you will turn it around completely in terms of how it's functioning. And if you look at any of the businesses which are successful, which are become a parlance for day-to-day, usage from consumers like us, be it going to a Book My Show so naturally and booking a movie ticket, it's a disruption that they've created in the market, so much so that, the first thing you want to do is you want to book a ticket is you just log on to a Book My Show. It's pretty much on everybody's mobile handsets. And once you can reach that stage, or you can or you can convince your investor that my idea has the ability to scale up to a level where it will become a household application, it will become a daily habit for every individual. That's really is the winning trick. And that's when you can really do anything with your projections, convince the person on the side of the table, and get much richer valuations. That's it. What really is the definition of startup? Well, the reason why people still call Flipkart a startup is because it's pretty much one of the pioneers of e-commerce startups in India, and that's why they call them startups. They're not really startups now, they're mature companies. If you look at the quality of management and the level of corporate governance these companies have, so much better than most of the established companies out there. The kind of board that the people on the board they have internationally recognized individuals on the board right now. So probably it's just a habit, because we have seen these companies evolve, that we've been calling them startups for 3 years, and suddenly 3 years back they were a startup, and now they've become a multi-million-dollar company that we still call them a startup. But it's just a way of just calling them. We know what's a startup, right? How do I define that? So,
I have a very small question to it. I have a very small question to Iqbal. Like you are talking about the model which IV is working. They have an outsourced model. and how this model will.
Hello, I just question to Iqbal Singh. Like you were talking about the IV model, so they are working on a outsource model and focusing, keeping assets light. But in terms, since they are into the health services, so customer satisfaction is the core of the heart. It's very important for the patient to go there and get treatment because they are working the projects within the projects. So a lot of doctors have been given, they have invested in the infrastructure. The core owner is not investing in that. He is keeping assets light. Building long-term trust, and how sustainable is this model?
What they have done is, when I'm talking about the asset light, land and building is not your USP, and it is eating out your capex. Let us suppose 100 rupees if you have to put in, 75 rupees is going into that business where anybody can do that. Any landlord will give you the land, and you give your drawings and things that I want the building in this manner. That's it. When I'm talking about satisfaction, what I'm talking about is I have to have a doctors, I have to have a latest technology where my investment is only 25%. Because why should I make my asset so heavy? And because in a multi-speciality hospital, it is a business which is requiring a huge capex. So the point is that if you keep your asset light, where you don't require any you can say USP or intelligence, why to invest there? There's no point to do it. You have to invest on doctors, you have to invest on new technology and leverage that. And what they have done, they started with Mohali and then they expanded to 6 places, and one of the German sovereign funds invested in that particular business because they say that you are providing healthcare to tier 2 and tier 3 cities. That's why I am investing. They invested 25% stake in that particular business model. And at the same time, what I'm talking about here is the multi-speciality hospital as a thumb rule. For, the cost per bed is around 1 crore. So their cost per bed is almost 30 lakhs. So they are going to be more efficient in terms of managing their limited resources. So what I'm saying is that you have to stick to your core competency rather than deviating to other areas. So keep your asset light, if you have to grow in that particular area and multiply that.
So I think there's a lot of things to learn from Mr. We are 1 hour late. Please go ahead. Yes.
So just to add to what Mr. Iqbal said, if you look at the case of hospitals, for example, right, one of the things that's always a nagging issue in hospital management is the unit called nephrology, right? It's so difficult to manage an efficient dialysis unit within the hospital. You don't have staff, there's so many people and there's a waiting list. It's a nightmare for hospitals to manage nephrology. And what has happened is because of this opportunity, there are so many standalone nephrology asset-light clinics that have come up, Nephro Plus, etc., etc. And what they do is they do standalone dialysis units. They manage the nephrology units of hospitals, and that way it's a win-win for both, right? You outsource a very difficult division to somebody who's a specialist who just does that for a living, and in turn you get steady revenues and higher quality of customers. So there's an opportunity for doing very strategic outsourcing, reducing your capex to OPEX, whatever, and benefiting apart from just the cost perspective also. And if you can identify an opportunity like this, there's definitely an area for creating a business around it.
Right, I hope you got the answer to your question, and that brings us to the end of this panel discussion, which was exclusively partnered by IFM, Mr. Iqbal Singh's company. Let's put your hands together for